Talking Point this morning. Mihir Vora, the CIO of Trust Mutual Fund, joins in. Mihir, very good morning to you and great to have you on. I'm just wondering, how excited are you by the pullback that we've been seeing in the markets? And I know we'll have that long-term conversation, but because top of mind right now is the pain over? And the street is kind of divided on whether this is a momentary relief or we really have, crossed the worst times. What is your view?
Hi, good morning. Always a pleasure. So let's just step back and understand. We all know why the slowdown happened, why the correction happened. It was because of government spending, extra tight liquidity, and the dollar strengthening. I think all those factors are coming to head, and we are seeing a reversal in all these factors. I think the most important part is that the government spending component will now actually hit us in a positive way in the June and September quarters, because 20% reduction in capital expenditure spending by the government in those quarters, which means that we have a very good low base to work on. So my guess is that optically the GDP growth and the revenue growth, etc., for a lot of corporates will look better in the June and September quarters, and that's what the market typically looks at, right? We are always looking at incremental, and we are always looking at the delta. So I think the markets have corrected, valuations have corrected, earnings downgrades have happened, and now we have a reset of the base, both in terms of valuations as well as in terms of growth expectations. And I think we should, be back to a normal market from this point in time.
Okay, so this reset, let me come to this term reset, and I think that's what's interesting, Mihir. What does that reset entail, and can that reset really happen if Q4 turns out to be disappointing? The sense right now is, okay, maybe better than Q3, but year on year, you're still going to end off slow and weak.
I mean, that's already the price, isn't it?
Yeah.
We've seen the indices correcting by 20%, 25%. Stocks are down 50% and 60% also. So a lot of the negativity is probably already there in the sentiments and the price. And markets probably tend to look a little bit ahead, at least 3 to 6 months ahead. And if there is reasonable confidence that the government order is back on track, defense, etc., are back on track in terms of the processing of orders and etc., then I think we should be back on a normal path. The good thing is that even the US is kind of backtracking on its quantitative tightening. The dollar index, from 110 to almost 103. That's a big move. So the risk of trade, which really drove a lot of asset classes globally, is now probably turning into a risk on trade, which is another tailwind for us. So I think globally as well as locally, the base has been reset. I'm not saying that it's all hunky-dory, because Mr. President Trump's announcements, etc., will continue to create volatility in the market. But I think as far as valuation and expectation and sentiment is concerned, we've had a reset.
Mihir, just good morning, Neeraj here. So just wondering, do you believe this is a W which might get sold into as well, or do you reckon that this is a restart of an uptick? The last 4 years we've seen dips getting bought into. Is this more of the same, or is it difficult to predict that right now?
See, the whole market has been supported by regular flows from retail investors. So I don't think any big money came in and big money came out. So W is not something that I'm looking at. Domestic and the retailers were always buying all through the last 5 months of correction, and FIIs were selling all through the last 5 months of correction. So nothing has changed. All I'm thinking is that even if the FII selling reduces or stops, and even better if it reverses, then we can have a big leg up because they are heavily underowned. I think you may have seen that for the maybe the second time or third time in 20 years. FIIs are in general underweight of in India in the global allocations. So if India starts to demonstrate, then we can have a big move from the FIIs if they start buying.
Noted. Okay. The other question is, Mihir, the pockets getting disrupted now. I'm going to the micro straight, right? And and I'm using cables and wires as an example, but large corporates are looking at pockets of high returns, high return ratio businesses, and making related expansions there. We saw that with Asian Paints, maybe doing it with adhesives, etc. But those were small things. Now we're seeing cables and wires, and a lot of other businesses too. We hear a lot of businessmen want to get into the quick commerce delivery space as well. Where do you think which pockets do you think are ripe for disruption and you might want to steer clear or keep exposure low or keep your eye out for any kind of disruptions?
I don't have a clear map in mind, frankly speaking, but I'd rather that corporates, spend money in kind of the newer cutting edge stuff, which is where China is really attracting a lot of attention. Than the traditional stuff. I think in some of the cases that we talked about, like in paints or in cable and wire, it's more of a related diversification because you have the ecosystem, you have the distribution, you have the brand. So it was probably natural for some of those corporates to go into those areas. But I don't see that as a big trend. Quick commerce, I don't think is that easy to replicate. It's not like you can put in 2,000 crores and replicate some of the big brands. It's not that easy because they have the ecosystem, they have the economies of scale. So I wouldn't be too worried about the e-commerce space. I don't think it's really possible to disrupt it that easily now. You would really require deep pockets for that.
Fair call. Okay. Okay. The other question, Mihir, is IT. And if AI disruption wasn't just enough for a large bank to say that they are changing the tracks of hiring from contractors to own employees, maybe they don't do it across the board, maybe some bit of it is done, but the rest, they might own companies as well back home, who knows? I mean, multiple things could happen, but it certainly disrupted the space and thoughts around people wanting IT. Now, are you constructive there because the pocket has corrected quite a bit? Or do you believe that because of all the uncertainty surrounding, there is a cap on the upside?
So in IT, I'm looking at it as large cap IT and the others, the mid cap and the small cap IT.
Okay.
Right? In large cap IT, we are underweight and we will continue to be underweight. The excitement that happened in 2022, 21, is maybe even till 23 on the IT space was because of a lot of preponement or pent up or extra steroid spending because of the COVID disruption. Because the same story, you had work from home, you had to upgrade your systems, and a lot of online shopping happened, etc. So a lot of bunching up of tech spending happened in those times, which is not a normal thing. So before COVID, if you see, they were growing at single digits, and after this bump, after this spike is gone, I think they are back to single digit growth. So I don't think it's a very exciting space to be in as far as the large cap IT companies are concerned. And frankly, they have not really invested in any cutting edge technologies like AI, etc., which can help them scale up in a non-linear way. So if it's going to be the plain vanilla services business, they are looking at single digit growth. So for us, it's not an exciting space to be in. On the mid-cap IT or IT-enabled space, I think there are companies which have unique business models. Some of them are providing services to medical companies. Some of them are providing services to insurance companies. We have some specialists in the auto space, etc. So mid-cap and small-cap, you can really pick and choose because they have specific business models. They have specific customers which they can mine better and grow better. So those specific companies we would pick rather than taking a call on the big sector.
I find that interesting, Mihir, because the announcement of 3 companies partnering with NVIDIA, I don't know if the last word has been written yet on Indian IT. Maybe a bit of lag there, but will we get to those shores? But if IT is underweight, what is financials looking like for you? Some views are coming in that that's going to be the biggest bet, the best sector this year.
Certainly, I would agree with that view, especially the large banks and NBFCs. Probably the NBFCs may benefit a little bit earlier than the banks, but if over a 1 year view, I think both banks and NBFCs should do well. Because if we are going to achieve a 6.5 GDP growth rate, then you can't have credit growth at 10, 11%. Credit growth has to pick up. So that's the bet we are taking, that we are back on the growth path, and credit growth should go back to at least 12, 13, 14% in due course as we go to FY26 and the second half of 26. So valuations have been beaten down in most of the segments in financials over the last 2 years because it had underperformed quite a lot. And if you are seeing credit growth coming back with RBI support on liquidity, etc., then you can see good earnings growth in terms of top line as well as margins.
And the large private banks is what you're liking the most?
Yes, absolutely. As I said, it's large NBFCs and large private banks, both. As I said, timing-wise, maybe NBFCs may benefit a bit more with easing liquidity and rate cuts. But if you take a 12-month view, I think both will benefit equally.
Okay, thank you, Mihir, for giving us your time. Always a pleasure to speak with you. And we hope to see you in studios next time that we have a
Certainly.
conversation. All right, Mihir Vora there of Trust Mutual Fund speaking on the market outlook, and banks are some of his stock picks as well. Large NBFCs and large private banks in particular.